Thanks for tuning in. So for today's analogy, I'm going to talk about the concept of a bear market explained by an NFL analogy. So let's imagine that the Colts have a number of veteran players that play on their team that previously performed at a very high level and were able to drive a lot of value to the team as a whole. They played very well whether they were on offense and defense, and they were valuable assets to the team. Over time, these veteran players may not be able to perform at the same level they were able to perform at when they were younger within the NFL and within the league. So as a result, the Colts have a number of managers and people within their organization that work to analyze this. And the team's management team will maybe decide that they may have to trade some of these veteran players for younger players that can bring more value to the organization. In a similar sense, this concept of a bear market is found within financial markets. So you may have a company like Google or some other company, IBM, etc., that trades different stocks, but for some reason, let's say that these stocks are no longer attractive to investors. So as a result, those same companies that performed at a very high level are no longer appealing to a number of people and investors. So as a result, you would see a situation where a lot of people may sell those same stocks to replace them with other stocks that may bring more value to their portfolio. So any constant drive or any constant transition from you having one stock or one player that had a lot of value, and then you have a huge push for people to sell those same stocks and those same assets because they no longer are performing at a high level, that results in a bear market. In a bear markets are constantly seen within the financial landscape, within all the different stock exchanges and any business environment. So I hope you guys found this analogy very helpful, and be sure to explore more content at www.simpme.com. Thanks.